typically in reverse order, right? You'll get the deal first, then you say, hold on, let me go back here. But what is the market? Who's the operator, whatever, and does this fit my own parameters? And so it's kind of a back and forth between those three things. But I think, market first, then the operator, then the deal.
You're listening to Ice Cream with Investors, a podcast that is dedicated to teaching you how to better invest your money so that you can live a more intentional life. I'm your host, Matt Four, and it is my goal to teach and empower you to remove the roadblocks to your financial success.
All right, Bronson, welcome to the show.
Hey, Matt, excited to be here, man. Excited to talk about ice cream and real estate, two things that are wonderful things. When you combine them, it's even better.
Near and dear to my heart. You are a man prepared for this show. So,
right.
We like to start with the difficult questions. What is your favorite ice cream?
Well, I was thinking I should show up with like a giant bowl of like 10 scoops of ice cream and just be eating the whole. Let's go. Hold a sec. I gotta eat. You just gain weight while I'm on the show. My favorite is probably mint chocolate chip. I like mint chocolate chip. I also like vanilla, but I think mint chocolate chip would win all day.
So our listeners know that's the answer I give to that question out of respect for my father. Because when I was a child, my father said, always get mint chocolate chip because no one likes mint chocolate chip. So no one will ask you for a scoop of your ice cream. You're proving that theory wrong, though.
Yeah, exactly. I guess I'm the one. So I would ask for a scoop of your ice cream then.
I would gladly give it to you. Well, tell our listeners, what's the scoop? What do you do today?
It's funny. I work with investors. I mentioned over 1,500 one-on-one phone calls with investors. We've raised almost $40 million for different real estate and alternative asset deals, such as ATM machine funds and car washes and oil and gas. And I do different passive investing beyond that as well. I used to be a medical device sales guy, so I did that. I'd sell equipment to physicians in surgery, and it was interesting. I was getting paid well. There's just one problem. I just had to go in and help these guys all the time. I didn't have freedom over my time. So I think a lot of people think of financial freedom meaning, I just have more than enough money, but really, when it comes down to it, for me, it really meant time freedom, right? That I can have time to travel, I have time to write a book, and I have time to do the things, spend time with family, things that I want to do or the causes I believe in. And so for me, that's been something that I've been really focused on. But what I really do is we try to find passive investment opportunities that are attractive for investors, that have certain parameters that really will either tax benefits or really high upside or steady cash flow that will help people to get to their financial goals. So that's what I'm passionate about. It's really what we do, and I spend almost all my time doing.
Awesome. Well, a lot in there. So before we get to all that, though, tell our listeners, where'd your real estate journey begin?
Yeah, so I think like a lot of people, I think everybody kind of knows, okay, real estate is a good thing. Like I should do real estate because wealthy people we know have done real estate. And so I thought, I'll do real estate and I'll buy a house. And so I bought a house. Ended up, living there for a while, and then keeping it as a rental from another state. Ended up acquiring a small single family portfolio, and my goal was to get to 30 houses. These are mostly in the Cleveland area, and if you're in inner city or kind of suburbs of Cleveland, typically it's a rougher tenant base, a little tougher with the city. The numbers look great on paper, but by the time you get kind of actually to start generating cash flow, you realize there's less than you thought, or maybe none. And so had some issues with that. And I have a cousin actually that I came in touch with that I hadn't seen in years, and he said, this single family thing sounds like a lot of work. Why don't you do multifamily apartments? And I thought, well, he did apartments. And I thought, well, I said, that'd be great, but I just don't have the money. And he said, well, you can raise the money. So he taught me about this thing called syndication, which is basically raising money from individual investors or people investing passively to go after bigger deals. So fast forward, 4 or 5 years, raised, like I said, almost 40 million. And I quit my great corporate job a couple years ago. I've had no regrets. And it's been great. So I think I've had 5 international trips this year. I have my book coming out shortly, and just really trying to create as much value as I can and create the life that I want as well.
You said Cleveland. Is that Cleveland, Ohio, or Cleveland, California?
Yeah. Cleveland, Ohio. Yeah. I live in LA, but yeah, it's out of state investing, and which I'm okay with out of state investing. It just means you have to have a really good team. And the challenge with single family, I think a lot of people think, I've got to start with single family, do that for 10, 20 years, and then I can go to multifamily. But I think it's just a myth. I think you should, in general, try to go to bigger deals because they tend to be more solid. They're usually, the management is better, and it's actually easier to raise money or do bigger deals as a partner. So I think there's a lot of positives to it for sure.
I would agree. Were those deals in Cleveland, were they like the turnkey that you see, or how did you end up in Cleveland?
Yeah, so I actually found a turnkey person, and they were just talking about stuff that they had around the country. They would do stuff in different markets in Phoenix, and where it was like, okay, 7 to 12% return projected in Phoenix, and 10% in Kansas City or 12%, whatever. And there was like Cleveland, 17 to 19% or something. I was like, what in the world? Like, what is that? So I was like, let me look at that. And so I just started looking into it and realized like there's a lot of houses there. I was like, do I really need to, if you're buying turnkey, you're basically buying top retail usually, right? Usually you're buying something fully rehabbed. Or I was like, I'm okay getting involved a bit. So we bought several houses and they were between, 15 and 30,000 each. I mean, this was at a pretty good time to buy. And then, we'd put sometimes, 5, 10 into them and get them rented for $1,000 a month or $900 a month. And they did well, but just again, the type of tenant you had there, it's hard because they're not, usually the tenant quality isn't as good. The numbers just don't scale. And that's why some of the stuff is here. If you're doing a $30,000 house and you're having issues with it, it's just a lot of work for not a lot of return versus you're doing a $300,000 house or a $30 million multifamily deal, right? Like it's really not that much different, except you do a lot more work on the smaller stuff versus having teams of people that can help with the larger stuff.
Yeah, I heard someone early on in my investment journey say, like, when you go to buy a water heater, there's not a separate section in Home Depot for, oh, your house is below $30,000, you get this discount on a water heater. A water heater is expensive regardless of where you spend the money. So you might as well own quality assets at a higher price point than some of the lower end stuff.
Yeah, exactly. Yeah, it's kind of counterintuitive. I think a lot of us, we know, we make so many decisions just based on subconscious things. It's like we think about real estate. What comes to mind typically is like, oh, well, I've lived in a house, as most people have. Well, maybe I should buy a house, and if I have a house, then maybe I could rent this out and go get another house, whatever. And it's an easy like understanding of how people get there. But that's really not how people usually become financially free unless they have like 20 or 30 years. I know people have been doing it for like 20, 30 years, but it really can turn into another job if you don't do it right. And that's why I'm really interested in growing wealth without taking up more of your time. And that's where Warren Buffett talks about, if you don't learn how to make money while you sleep, well, you're working until you die. And so there's this idea of passive investing. A lot of people think it's like owning an online business, or it's actively trading stocks, or it's having a single family portfolio that you manage. I think none of that's passive, right? Passive is if you can't 10x what you're currently doing, meaning deploying 10 times the amount of capital, you're not passively investing. So if I have 3 houses, then could I go to 30 houses without, and actually manage that effectively? That's probably no. It'd probably become your full-time job, right? So I think it's important to evaluate. And that's the nice thing about syndicated deals or deals that are private placements that are more passive. There's nothing fully passive because nobody cares about your money the way you do. But I think being able to see a deal, look at it, analyze the team, and do your work on the front end, and then choose to invest, and then realize, I'm not managing this at all. Like it's someone else is managing it. I'm maybe looking at the statements, I'm getting the cash flow, and that's a great way to really get that mailbox money.
Do you still own those homes in Cleveland?
Nope, I sold them a few years ago. So I rolled it into multifamily, larger stuff, and so I decided, it was just, it's just kind of the brain damage of it, right? You get, oh, this thing happened, the tenant didn't pay, the toilet exploded, whatever the thing happened, it's like, I don't want to hear about that stuff, like just figure it out. But with large multifamily, you don't have to, you get so much more, it's so much more efficient versus paying some maintenance guy $50 an hour to go to the place, go to Home Depot, get the part, come back, fix it, whatever, and do that with every house. It's like you have typically all the same fixtures in an apartment, the same paint colors, the same appliances, the same toilet. I mean, it's like much, much more efficient. And you hire the maintenance person full-time at a very significant discount. So you're not paying those crazy, like normal rates, right?
Yep. So tell us, you mentioned multifamily a couple times. What does your portfolio look like today?
So we have about 2,000 multifamily units. We're mostly in Jacksonville, Florida. We've got a lot in Jacksonville, value add multifamily stuff, usually 70s, 80s build stuff. We have some stuff in Atlanta, and then we've got one in Houston. So, we've shifted a little bit. We still are doing, multifamily. We've just shifted a little bit to go less value add and more conservative, kind of long term, almost loan assumption type of stuff. You assume a loan that's got 7 or 8 years left on it, and it's, you'll get it, basically you'll know that your debt cost is pretty fixed, and, but lower returns, lower projections, just do some stuff that's a little more conservative these days.
How was your portfolio, let's start with the multifamily, kind of weathered this cap rate suppression and then expansion. So what I mean by that, in 2019, we saw cap rates starting to tick down in the value add C-class space. In 2022, I was starting to see them trade at like 5.5 caps. And now I'm feeling like they're expanding back to the mean. Can you talk us through like kind of how your portfolio's weathered that?
Yeah. So it's interesting. If you look back historically, people that invested, 2010 to 2020, or team 21, early part of 22. I mean, anything you could do, you could just own stuff. And for the most part, you just look like a genius because you were an owner, right? Like you didn't really have to operate super well, just as long as it cash flowed. And, about once they started really raising rates, it has been much more challenging for a couple of reasons. One is, we'll have any sort of value add project, which, you're assuming, hey, we're increasing rents, so there's some kind of safety there. We've seen deals we've renovated the majority of units, and the property's worth 30% less than it was when we started, right? And that's like, how is it even possible, right? Well, so some of it can be challenging as far as valuations. Even no matter how much work you do, the valuations are coming down. So we've had a couple capital call situations. It's definitely been challenging. It's really kind of got me rethinking just the whole prepayment penalties. We had a couple deals we sold early on fixed debt that we paid literally millions of dollars in prepayment penalties, but that feels a lot better than the other way of having to go ask for more money or potentially having a loss. So it's definitely been a learning experience, I think. Now, in reality, I think at multifamily, typically, I did talk with one investor that we have in one of our deals where there's a capital call situation, and he said he's in 5 other capital calls in other deals that he's doing. So again, it's not just like there's one; it's kind of industry wide. We're seeing, especially in Florida, insurance has gone up literally 300%. We're having increasing costs of labor and materials of 30 to 50%, and rents have risen, but not a lot, not as much as that, right? So we're seeing just even deals that were performing really well have really been pinched on the cash flow. So I think whatever you're doing, it's important to just continue to keep learning and continue to, okay, what can we do here differently? What are the things we can do? For me, what I learned is I think fixed rate debt is, much better. And I think if you can have a longer term fixed debt, even if your returns are lower, even if your returns are, hey, we're projecting 10, 12% or whatever, there's going to be a lot more upside. I think this is actually, right now, is actually a really good time to invest. It's just harder to get investors excited about it because they'll think, oh, my multifamily must be bad because I've had some issues with my multifamily. It's not cash flowing, whatever. Well, like you said, cap rates are coming up. Deals are getting better. It's getting way better. And, when you buy, your buying price is fixed, but you can always refinance later. So if rates are, you're paying a 7% or 7.5%, whatever it is, you can always, as long as it cash flows, you can always refinance later. And so, but the buying price, you can't change. That's a fixed thing. So I do think, right now there's definitely some opportunities. It's definitely some growth opportunities too, just to learn. And, I think, that's one of the reasons of the last year and a half, we've shifted a little more to go a lot more alternative stuff that is much more consistent cash flow, like ATMs and car washes and oil and gas.
Yeah, I want to talk about ATMs, oil and gas, and car washes. But before we get there, I don't want to skip over the point of fixed debt having prepayment penalties. One of the questions I commonly get asked by investors is like, why did you choose floating rate debt on this? Well, when you start doing the math on it, like it is literally $1 million plus decision on not only prepayment penalties and yield to cost and things like that, but also in terms of what you can lock that in at. So looking back on it, I definitely think anybody who locked in and fixed rate and was able to have a more consistent debt assumption or debt position is probably doing a little bit better today. But also that was $1 million plus decision probably at that time to make that decision. And don't get fooled that somewhere you paid for that fixed rate debt.
Yeah, anybody that did it, a year or two ago looks really smart. We had a couple of deals we did that on. It's like, oh, we're really smart. We did this. But it's hard. It was hard to say. Is the Fed? They were so committed to low rates for, it was about 2 years ago. They were just so, we're just going to keep it zero and it just like immediately switched. So sometimes it's hard with the Fed because they give guidance and then they just like immediately, now we're doing this, and it's like a complete about face. And so they're consistent until they're not, or they kind of go a direction until they're like, oh no, actually we're going to do all this and we're going to move it this way. So I think it is important to have a plan, and I think. It's unfortunate because if rates rise quickly and valuations drop, and you can't, there's a pinch there, right? There's a pinch that says, hey, if you're trying to refinance a property or you're trying to, basically, get more money or figure out something out and you're having issues. Even if you're not having issues, you do all the renovations and the value is just not there. So you have to try to figure out a way to extend your loan or put a cash in refinance or just stuff that's like, it's hard to stomach a little bit, like, oh man. But I think right now though, because some valuations have dropped, it is, like I said, it is a good time. So it is something that people should be interested in looking and be deploying, I think, more now. The problem is when people have had any kind of a situation where there could be a loss, it just makes us real cautious. They say psychologically, we remember our losses like 2 to 3 times as much as we remember an equal gain. Yep. So if we lose money, it's, oh, I never want that to happen again. But it's like it's almost traumatic. So it's kind of like a human bias, right? That we're so anti losses. But anyway, and Warren Buffett even said, rule number 1 is don't lose money. Rule number 1 of investing is don't lose money. Rule number 2 is don't forget about rule number 1. So if you can avoid losses, but even that's even more case for fixed debt, I guess as well. But definitely challenging to decide between those two at times.
Yeah. And to your point around now is a good time to invest. When we see interest rates at 7-8%, let's call it, when the Fed stops deciding to raise rates and they bring rates down, or for some reason the 10-year Treasury goes down, then when interest rates will go down, prices will go up as well. So it's kind of a Jekyll and Hyde situation where you're stuck between two rock and a hard place. If you just had a capital call, you don't feel like now's a good time to invest. However, it's the reverse where the best time to invest is when their blood's in the street, I guess.
Yeah, absolutely. And it feels counterintuitive, but it really is. I mean, it's a contrarian investor, right? Be fearful when others are greedy and be greedy when others are fearful. And it's not that we should be terrified in fear or we should be greedy, but it's just being aware. Like when everyone's doing one thing, maybe it's time to kind of start backing out of that a bit or start softening that position. And when no one's doing something, maybe it's time to jump in. So one example of this is when oil crashed to minus $38 a barrel, I was trying to think, how do I take advantage of this, whatever. And so I got into like some ETFs and different things. And I like doubled or tripled my money within a year. It was great, but I didn't hit the perfect bottom or the perfect top, but like, I was really happy that I got in. So, but it's just, again, sometimes we think things are never going to change, but they continually change. And so it's the idea of finding something that's a little out of favor. And I think right now, multifamily's gone from being super in favor to being a little bit out of favor. So that's actually an attractive quality.
Agreed. So you mentioned alternatives to the alternative investing, such as ATM, car washes, and oil and gas. Specifically, I want to talk about ATMs because I've never had somebody on the show to talk through ATMs. It is something that I continue to evaluate. Huge tax benefits, great cash flow, all those sorts of things. But talk to us a little bit about this space and why you were interested in that.
Yeah, so it's really interesting. I just had a call earlier today, and this commonly happens. And they're like, does anybody use ATMs? I haven't used an ATM in 10 years, where I haven't paid for a fee. And it's kind of an interesting dynamic because the people who invest in ATM machine funds or invest with us never use ATMs and pay a fee, right? But statistically, the FDIC said that 4.5% of all households in the U.S., this was in 2021, 4.5% of households, not a single person in the house has a bank account or in the household has a bank account. And then about 10% of Americans overall, 10% of Americans do not have a bank account. So these people are using cash. People get paid cash on the table. Unemployment benefits now come on debit cards. People are using prepaid debit cards. They're sending money international. They're doing all this stuff. So there's actually quite a few people operating in cash. So we've seen just consistently around a little over 4% growth in the number of ATM transactions annually, which is kind of amazing, right? To see that kind of growth just continually. And the projection is that it's going to continue to grow. And so, for all this currency they've created as well. So it is interesting to see. And again, what I like about the investment that we're involved with is that it's the most consistent cash flow deal that I've seen. Now, every investment has risks. Obviously, the risk is, do people stop using cash or is there an operational issue, whatever? Well, in over 11 years of operating, the partner that we're working with, which is the 4th largest operator of ATMs machines in the country, they haven't missed or reduced a single preferred return monthly payment. So just for example, this is an example, not a specific offering or anything, but 100K invested has returned around $2,100 a month starting month 4 after the investment and pays out for 84 months and then it ends, right? So it's kind of this idea that like you're just getting consistent cash flow and it's a mix of principal and interest. And then at the end, the investment just kind of ends. There's no big lump sum at the end, which makes it different than multifamily. But the fact is you get paid back so quickly that within a couple of years, you can get a significant portion of your money back and go reinvest, right? So that's kind of the cool thing, is having cash flow investments that are predictable. And as predictable as multifamily has been, usually it takes a little while to get going. And then lately it's been like, man, it's been hard to find deals that actually cash flow consistently, right? Because of the different costs, like we mentioned that talked about. So that's cool. The other thing is that it has 100% depreciation, and the depreciation is actually better than real estate depreciation. So what I mean by that is when you have a multifamily deal, you have, 25, 27 and a half years, whatever the schedule, and you bring it forward to year one, you get all this depreciation, but you still have to recapture whatever years you didn't use whenever you sell in year 5 or whatever it is. Well, with these ATMs, it's a 5-year depreciation schedule that goes to 0. So you never have to recapture. So we've had several investors that have over $1 million invested each, just because they can't find anything like that has that type of depreciation with that kind of cash flow, and it's been really ideal. So this year it's 80% year one, and then you get the 20% the remaining couple of years. But again, there's a lot of directions we could go with that, but that's kind of a quick overview.
Yeah, so some of these investments that I've looked at, essentially you're earning your capital back within the first 4 years, and then it pays out for an additional 3 years, 4 years, something, 3 years.
Yeah, sure.
So after that, it's just all upside. And then to your point, like you're getting $80,000, let's call it, of depreciation on a $100,000 investment in year one that you can allocate across your portfolio, across different cap gains or things like that. I will throw an asterisk here. Neither of us, Bronson or myself, are CPAs. We're not your CPA. Don't sue us. But ultimately, that's a pretty strong argument for cash flow and strong depreciation.
Hey, fellow investors, before we dive into our next segment of the show, I wanted to take a quick moment to talk to you about a fantastic opportunity for you to invest with me. As you know, here at Ice Cream with Investors, I'm passionate about real estate investing and helping you navigate the exciting world of wealth creation through real estate. And that's why, for the first time, I'm thrilled to tell you about an opportunity for you to invest alongside of me. Over the past 3 years, I've been investing in multifamily, mobile home parks, car washes. I've even become the bank and lent out money to fellow real estate investors on a short-term basis. And now you can come join me. If you would like to jump on a call and learn more about this opportunity, head to icecreamwithinvestors.com/invest and find a time for us to connect. And now back to the show.
Yeah. And at the end of the day, I mean, I realized this is a kind of a cool strategy. When I was working medical sales, I was making $200K a year, and it was great, but I was, still paying $50K in taxes, right? So I was making maybe $150. But when I realized if I was able to use these tax incentives, which, there's something called the real estate professional or REPS status that the IRS allows for, I could make $150 and I could basically keep the same amount of money.
Keep it. Yeah.
So, it's kind of amazing. So I realized wow, there are actually ways that it's kind of about using these things. People call them loopholes, but I call them incentives because, when the government, they have an agenda, they need to provide enough energy to people. That's why there's some incentives in oil and gas. They need to provide housing. And when the government provides housing, they don't do a good job. Think about like government projects, right? Nobody wants to live in the hood in a government project, right? But that's what they do. And the government housing that's typically what they look like. So they like these private partnerships because they know they'll get a better result. And so they give incentives to individuals who invest or operate those deals. And so I'm really passionate about, I actually got a whole chapter in my book about reducing taxes potentially to 0. Again, just educational. I'm not giving any personal advice, but just sharing a little bit of my story and other people's stories.
Yeah, it literally changed my financial life when I realized that the tax code in America is not made to drive revenue. It's made to incentivize the private individual to go do something that the government wants done. And the 3 areas that those are for me are housing, energy, and agriculture. If you do something in those space, if you house a population, if you give energy to the population, or if you feed the population, chances are you're going to get a pretty big tax benefit along the way.
Yeah, absolutely. Yeah, it really is. And Tom Wheelwright, my friend, he talks about this in some of his books where tax-free wealth and some of these books that it really works pretty much the same in every country of the world. The whole cash flow quadrant, like how much you pay. If you're an employee, then you'll pay typically up to 40%-ish tax, or maybe a little more, but around that. If you're a high, like a self-employed or a physician, you're up 50-60%. And if you're a business owner, it's usually around 20% because you get a bunch of write-offs. And then if you're an investor, you pay 0. And it's kind of, no matter what country of the world, it's kind of that it always works out. And it's just because of that reason is that it's not like everybody's colluding around the world. It's just that no, for these things to work, and if the government has incentives they have to create ways that create incentives for investors. So some people get upset about it and think, oh, it's not fair, and why do they do that? Whatever. It's like, well, if you want to change that, you can just get aligned with I worked with physicians for years. They were paying 50-60% taxes, after everything. And I was like, there's some options there. I've seen people, their spouse becomes a real estate professional, or they go part-time. And even if they worked half-time and did some real estate stuff, they could probably keep the same amount of money. So it's kind of wild, how this all works.
Yeah, and step one would be to run for Congress. I mean, at the end of the day, like the playbook is the playbook. I didn't write the rules. I can disagree with how they're written, but if I want to change it, then there's one option I can do, and that's go to Congress and change it myself.
Yeah, exactly. Yeah. But even if you change it, it's like, this is how, if it exists in almost every country in the world, then, it may not just be a go to Congress thing. It's like, how do you have a productive society? It's like, okay, we've got to create things that are important, and energy and housing those are two very, very important things for sure.
Yep. So you mentioned at the beginning of the show that you've talked with over 1,500 investors, which is quite a lot. I would love to learn from you. Talk to us what you've learned from those conversations. What are some of the gotchas that first-time investors should be asking but don't ask? What do you like when investors ask you as the operator? Talk us through that.
So I don't know. I think it's, I think when I get on the phone with someone, it's just interesting because people come from all different, backgrounds and levels of experience. Some people are like, never done anything except for stocks. They've got a money person. There was a guy that I talked to, a physician who had his own practice, and he had $5 million net worth, and he'd only done stocks. He had his money person, and he'd never done anything outside of that. So that's going to be a much more basic conversation of how syndication works. And here's, when I first heard about syndication, I was like, is this some sort of crime thing? Like a syndicate crime thing, or like a syndicated TV show? I just didn't even know the term. It was so different. But so anyway, it's just kind of depending who's on the phone. Now, if somebody gets on and they've done 20 passive deals, and we're gonna talk about cap rate, reversions and conservative metrics and fixed rate versus, bridge debt, and you're just gonna have a whole different conversation. So everybody has different things, but I think the biggest things, the commonalities for a lot of these people, a lot of them are interested in reducing taxes or finding ways to shelter taxes. These people are, I actually kind of evaluated what's the average net worth that I've spoken with. It's around 2 million. We've had some that have, north of 10, 20, 30 million, but a lot of people are, high net worth, really trying to figure out, hey, how do I grow this? What can I do that would be beneficial to grow my wealth outside of Wall Street? So that's a big one. And then, again, a lot of these people have more money than they have time, right? There's a desire to really try to become more passive. And so, like I mentioned, a lot of people own a house or two, and they're like, this just isn't going to work to get me where I want to go. Like if I have a business, if I sell my business, I'll make some money, but how am I going to actually generate cash flow, right? And that's the thing I think that skill, if you knew you could invest in something and get around 10, 15% per year, which is way higher than what the stock market and other things promise, if you could just consistently do that, then you'd be in great shape, or you wouldn't actually need that much money to be able to survive on, right? And that's why my book, Fire Yourself, which is just coming out shortly, it's the subtitle is Replace Your Working Income with Passive Income in 3 years or less, right? So how do you do that? How do you create that process? So all those calls kind of culminated really in the book of just a path of why Wall Street isn't working, what passive income really is, and what are some options that are out there, and how do you vet a deal? How do you vet an operator? If you've never done this before, how do you, I don't want to lose money, so how do I avoid that, right? And so we have a whole, whole section on that as well.
Yeah, talk to us a little bit about how you vet a deal. So as an operator, you have as a passive investor, I'm sure you have your procedures that you walk through to kind of vet a team and operator in a deal. Talk us through that.
Yeah, so I have actually there's a graphic I use. It's like a funnel. So you have at the top you have the market, you've got below that the deal, and at the bottom you have you have the market, you've got the operator, and then you got the deal. So a lot of people would say, oh, you start with the operator. I was like, no, I like to start with the market, because whatever the market is, if you're in the right market, and you can do a lot of things wrong, and you'll still be okay, because the rising tide will raise all ships. So we look at that, what's the ATM market look like? What does the workforce housing in Jacksonville, Florida look like, right? Is the population growing? Is the income growing, rents growing? What's the landlord rights? We look at all these things to kind of determine what does the market landscape look like. So it exists in every asset, not just multifamily, but different markets, different types of, car washes, different things. So we look at that, and then we try to make an assessment. Is it growing? What's the trend here? Are we in the right market? If it's a shrinking market, if there's some real issues with doing it, that's again why we don't buy in California, because it's very difficult to do what you want with your property in California, right? Somebody can squat for a year. There's actually a story of a woman who went into an Airbnb, and you saw this, in Beverly Hills in some mansion, and she paid, I think she was there one night, and then she's been there for like 2 years, and the person cannot get rid of her, like literally, because of all these little loopholes. So, we want to know we can do what we want with our property. So the market is the first thing. Second thing is that really the operator or the team, like who is the team? What's their experience? What's their background? What are their values? I used to think we all valued the same things. A lot of people want to raise money and they never want to talk to investors again. And I'm like, that's not, we want to have a relationship with our investors. So we talk about our values and where we're at, and you want to make sure those things align. And then, what is the specific deal? And does that deal match up with your specific goals and what you want? And also, does the deal match the operator? If the operator's been great in Atlanta and they've done a certain thing, is this one a whole new market with a new property manager or a new type of asset? Doesn't mean you won't do it. You really want to make sure that you understand it. And then kind of at the bottom of that with the deal, it's like there's typically, one or two, you understand how you're going to make money with this deal. You understand how you're going to make money and what's the one or two primary ways that you could lose money. And if you don't understand that, then you probably don't understand the deal well enough as a passive investor or as a partner. So it's important to really think about that, maybe study more. And also, I ask when I have phone calls, to get on somebody's list, I'll ask them, say, what do you think is the primary risk of this deal? And if they're like, oh, there's no, this is so safe, secure, what it's like, well, then run, because like they haven't thought it through, or they're not being honest, right? So, and sometimes they will say something different than what I thought. I'll think it's this, and they'll be like, oh, I think it's this, and I'm like, oh, that's right, I didn't really think about that. But again, you're trying to get a handle on both what is the upside and what's my downside here. So, but they actually do come to you typically in reverse order, right? You get the deal first, then you say, hold on, let me go back here. But what is the market? Who's the operator, whatever, and does this fit my own parameters? And so it's kind of a back and forth between those three things. But I think, market first, then the operator, then the deal.
Yeah, two things I want to highlight from that is, one, I always like the market too. A good market can save a bad deal. A good deal cannot save a bad market, in my opinion. Yeah. And two, I'm on a big, this is conservatively underwritten bashing streak right now. Every operator I've ever met in my life says, boy, we are ultra conservative in our underwriting. And the real answer is maybe in some areas, but in some areas you're risk on. And what I want to know is, where are you taking that risk? And then how are you mitigating that risk if that were to come to fruition? So.
Yeah, exactly. Yeah, and that's, nobody walks around and says, it's
an aggressive deal.
They say like 85% of people describe themselves as above average in their driving skills. And it's like, well, we know that's not even possible. Like you can't have that many people, but it's the same. No operator is going to be like, I'm kind of mediocre in my underwriting here. Like it's just really not, it's kind of shaky, but you should invest anyway. It's like, nobody wants to hear that, right?
Boy, if one thing goes wrong, this deal blows up, but I think it's a good deal.
Yeah, it is kind of like a word though that's kind of like if people hear it, they're looking for they use the word conservative, so they're thinking about what I should be, and I get it, like, and we use it too, but it's also like you can say whatever you want to say, but like show me in the what is the rent growth assumption, or what these days, like how is this conservative, and I found great deals. I used to think, when I was first starting out doing this, it was like, if 15% in Atlanta is good, maybe if a 17% return, but that's even better, right? But I've realized experienced investors, they'd rather have like a 12% projected return. And like, you say, hey, here's all the things that we didn't even put in the underwriting that like are potential upsides that we think we're going to get, but we just didn't want to put it in there because we wanted to be more conservative. And that's like, oh, that feels really good, right? Because then you're like, you've set a base expectation, and then you're like kind of building upon that. And so it's a different way of doing it. But I think I really like deals like that.
Yeah, I invested with an operator in 2021, and we're selling, that deal is selling in November, and the IRR is like 10.8%. And I am ecstatic with that deal right now, because it had 3.5 floating rate debt when we bought it, and now it's at like 5.8 or something like that, 5.75. So still not in like danger zone, but ultimately, like if we are flipping a profit in 2 years, I'm okay getting my money back with some friends and the tax benefits I got along the way, and redeploying that somewhere else, and let's go at it again. What I don't want to be in is, sorry, the bank is taking back this asset and you're not getting any back.
Yeah. It's interesting too how just even the whole perspective has changed in the last couple of years. I remember I've had so many calls the last few years, but like, it for a while it was like, oh, this I don't know, you're only at 14% IRR, 15. That's a little too low for I'm looking for something a little. It's like, but now it's like and it's true. Like, hey, I just want to get my money back. I just want to make sure things are going to be okay, or is my capital secure? And it's just interesting how expectations and things change when the market changes. And I just think it's important to be flexible, and also there's other things we cannot project, but that's why I think I've learned to just honestly through this some of the floating rate stuff. I'm going to be very leery to get into any more floating rate stuff in the future, just because there is a place for it, and there is a place to use it, and there's a place for it. Construction loans are pretty much all floating rate, and there's a lot of value add stuff. You do a lot of that, but having a property that's stabilized enough to have fixed rate debt and just kind of do it slowly over time, some of the value add stuff, it seems attractive because it protects your principal.
Yep. Well, Bronson, fantastic conversation. I want to switch us now to our last round. We're calling this the 4 toppings. Our first one is, what is your favorite book, or what is a book you've read recently that's given you a paradigm shift?
Well, see, a great book I read, I'll give 2 books. I gave a bunch. I read a lot of books, but there's a great book called Never Split the Difference, which is by Chris Voss, just on negotiating. I think that's a great book. There's a book on the personal side that's called The Gifts of Imperfection by Brené Brown. And that's actually probably my favorite book of all time. And it's just talking through how do you live a wholehearted life? How do you own your story? How do you work through shame? How do you just things that like becoming a more well-rounded person, I think. So that a couple great books that I've read. I'm reading one right now called Breath by James Nestor, just talking about the power of breathing correctly. And I read a ton, so I'm a big nerd.
Yeah. I've got a lot of those books that you mentioned, Breathe, Never Split the Difference, all that behind me. So
yeah.
Our second one is, what is the best piece of advice you've ever received?
There's probably a lot. The one that comes to mind is to grow your wealth. The 2 things that will get you there are networking and education. And they sound not super sexy, but it's just so true. You're the average of the 5 people you spend the most time with. So getting in the rooms with people that are next level, so you can go to the next level, and just educating yourself on as much as you can and learn as much as you can. So yeah, I almost look at that like, you're a big fitness guy as well. It's almost like physical fitness, right? Like getting your mental fitness in. So those are, I think, probably the best advice I've received.
Yeah, the best way to grow your wealth is through networking and education. I have never heard that, but now when I look back on my life, I've always had the education piece, and I skipped the networking piece. And if I had to point to the biggest mistake I made over the past 7 years that I've been in the space, is networking. It was really only the past 2 years that I've tried to get out there and make connections, and so I love that piece of advice.
Yeah, there's a quote. There's a quote that says you'll be the same 5 years from now, except for the books you read and the people you meet.
Yeah,
and I think it's so true.
Yeah. Our third one is, what are you most proud of in your life?
I'm most proud of being a dad. I have an awesome 10-year-old daughter, and I try to be the best dad I can, and just so proud of being a dad, being her dad.
Yeah, just one.
Just one. Yeah.
Okay. Nice. Our fourth and final one is, if you could sit down and eat a bowl of ice cream with anyone, dead or alive, who would it be and why?
Oh man, there's so many people. I think I'd like to have a bowl with Jesus. I'm just a big Jesus guy, so I think that'd be awesome to just. And I don't think ice cream was around when Jesus was around, so that'd be awesome to experience ice cream with Jesus.
Yeah, he might have been able to make some though, right?
Yeah, he could probably if he could turn water to wine, he'd be like, I'll make some ice cream here.
Yeah. Bronson, well, fantastic conversation. If our listeners wanted to reach out to you, learn more about you, or connect, where is the best place we could point them?
So yeah, the best place, my website, bronsonequity.com. I have my ebook as a free download there, some strategies in using inflation to your advantage. Also, I have my new book, which is behind me here, called Fire Yourself. That's a full-length book on Amazon. Like I mentioned, replace your working income with passive income in 3 years or less. That's at Amazon, so you can check that out, called Fire Yourself.
Awesome. We will link those in the show notes. And then, Bronson, thanks for coming on.
Thanks so much, Matt. Appreciate it. This was fun.
Thank you for listening to Ice Cream with Investors. If you like what we serve you here, it would mean the world to me if you would like, subscribe, and leave a review on your favorite podcast app.